Oh, we're all in the holiday spirit today, folks. Good morning. Welcome to the Street's opening bell here from Post 35 on the floor of the NYSE. Today is Wednesday, the 23rd of November, Thanksgiving Eve. I'm JD Durkin, a very special guest. He is the CEO of Christmas himself, Kris Kringle. He has held this position atop Christmas for a very long time. Santa Claus himself, yes, is here on the floor ringing the opening bell with Macy's in celebration of tomorrow's 96th annual Thanksgiving Day Parade. You may see Santa Claus over my shoulder as he exits the trading floor. A lot of people here in celebration. Of course, very early. Happy Thanksgiving wishes to all of you at home. The major indexes are mixed to start out Wednesday's session as the Street looks ahead to the upcoming Fed meeting minutes. And, well, I should say the upcoming Fed meeting in a few weeks. Investors seem to be shrugging off COVID concerns in China as they shift their focus to the future of interest rates. Traders on edge a bit as they bet that the central bank may finally start to step down monetary policy. We'll see. Taking a look at what is on tap for this morning's broadcast, we will talk renewed lockdown fears in China as COVID cases continue to earn headlines in that country. Plus, we preview the Fed's meeting as investors bet on a 50 basis point rate hike as opposed to 75. And finally, as Tesla continues its decline, is this the buy-in opportunity? Is this the buy level? Buy the dip? Are we at the dip? Who knows? For more on those stories and so much more, let's bring in the man who probably does know. He's our senior editor, our markets correspondent, the general man about town, Mr. Martin Baccardax. Martin, happy early Thanksgiving wishes to you and your family as well. I appreciate you being here. I appreciate you being here, as if we don't do this every morning. Thank you for being here today. Stock futures are up. What is top of mind for you and you think for many others on this Thanksgiving Eve? Are we expecting a bit of a low volume day, seeing as I'd imagine a lot of people are on the roads ahead of tomorrow's holiday?
Yeah, I fully expect so, JD. We were at about 80% of normal volumes yesterday, and I would imagine that number will fall today, and of course, be similar on Friday as well. So the thin liquidity is making things move kind of in different ways that aren't necessarily easy to digest, but I would call us flat to the start today, hoping for the third gain in 4 days if we are to manage some green territory by the close of trading. But you sort of hit the nail on the head. Investors are sort of sensitive with respect to Fed speak, and as a result, they're going to be focused on the release of the November minutes this afternoon. There was, of course, a bit of difference of opinion from the statement of the Fed meeting in November and the actuality of commentary from Chairman Powell himself. We'll try to pick through that, of course, as we dig into the minutia of those meeting minutes. But ultimately, I just think that we are drifting ever higher, albeit at a modest pace. And we are sort of testing this theory as to whether this is some sort of bear market rally or something more sustainable. At this point, you might think that it is more on the bear market rally side, but there is evidence pointing that the momentum could continue.
I do want to get your sense as to why you think investors have at least appeared to have shrugged off concerns of further lockdowns in China. We're talking about the world's second largest economy here. We've seen these headlines, yet it does appear, at least in this particular climate, Martin, in this moment, maybe there are other more domestic concerns that investors are focused on. Is that a fair read? And what more should we know based on those headlines overseas the last few days?
Well, I certainly think it's an enormously important story, and the numbers are definitely moving in the wrong direction. Infections rose again overnight to just over 29,000. That's the official tally, so you can imagine that the actual number is significantly higher than that. There's lockdowns in Beijing. The infections are spreading into Shanghai and other cities as well. And we're seeing protests from people as a result of the strict conditions on movement, business and travel, and much other things from the government in Beijing. So I do think it's a big story. I think it's one that's going to, of course, hold down economic activity in China, which, as you mentioned, is the second largest economy in the world, and it's going to have further disruptions for supply chains as well. But to your other point, I think the fact that markets do seem to be shrugging it off, probably at their peril, is the fact that now we are really into the case of valuations as opposed to fundamentals. I think the broader assessment is that the US economy will slide into recession next year, albeit a shallow one. And therefore, what you need to understand at the moment from stock prices is, are they presenting you with the kind of value that you need in a recessionary environment? that for the most part is going to be predicated on what the Fed does as opposed to what happens in the fundamentals of the global economy, because they seem to be on a set course at the moment. Even if China were to pivot, it probably wouldn't pull the economy out of recession, at least in the near term. It may change the depth of it, but it's not going to change the reality of it. So if you are focused on valuations, that puts you more sensitive to interest rate moves, and that puts you in turn more sensitive to changes in Fed language. That's why the minutes are important today, and that's why we have been so focused on Fed speakers over the past few weeks.
Speaking of Fed, we've talked a lot about Fed pivot, but to this point about China, you said there's not much of an indication of a China pivot. Is there anything out there that gives us any indication as we look into 2023 that maybe some of those restrictions would begin to change? Or is that unlikely, given the reaction and stories we've seen, even this in the last 7 days or so?
There doesn't seem to be any visibility on that, JD, with respect to a change from the government. It's a signature policy of the new administration of Xi Jinping. And of course, he's only just established his third term as president, which is unprecedented, a few weeks ago. So the chances of him changing tact that quickly seem, at least on face, to be rather remote. I think what could change the picture for China in the near term is if there are accelerating domestic protests potentially turning violent as a result of some of these strict conditions. We're already seeing, frustration amongst some citizens. We're seeing commentary and criticism pop up on social media in a way that it hasn't in the past. And I would imagine that that will be the precursor to any significant change. The last thing that Beijing needs right now in a downturning economy is civil unrest. So they may want to try to have nuance between something that they feel is effective from a health policy point of view and one that allows economic growth, because both are equally important for this new regime.
Martin, from time to time, I like to ask you for an update on the U.S. dollar, specifically in that index. We have seen it go high. We've also seen it be in retreat mode more recently. What is the latest on that, and why might that be something that people want to follow, at least store away in the back of their brains, understanding tomorrow is a day for maybe for football and the parade and Thanksgiving, but I don't want people necessarily to lose track of it if it's something that you feel it's going to be increasingly important for them to pick back up in terms of focus after the holiday.
Yeah, the dollar seems to be a good repository for a lot of people's visions as to where we're headed, both in economic terms, where we're headed in interest rate terms, and where the market is in terms of its risk appetite. And therefore, we have seen it come down from those multi-decade highs that it printed in the latter part of September. And those declines seem to be not accelerating, but certainly consistent. We were lower overnight against a basket of global currencies, which is really what I follow the most. It's called the dollar index, and the ticker symbol is DXY. And again, it sort of reflects broader growth in risk appetite this week, but again, caveated with lower liquidity and thinner volumes as a result of the holidays, but probably also the fact that there is a growing consensus that inflation in the United States has peaked. It will be on a slow downward trajectory over the next 12 months. That will reduce the need for deeper Fed rate hikes and therefore reprice the US dollar downward against its global peers. So for the most part, I would say, though, those are the most powerful dynamics that are driving the dollar right now. And again, it's off those multi-year highs and extending declines in early trading today.
I do want to ask you about not just the week that was, but really the last 2 weeks that was with regards to retail. I had some retail sales showing strong gains, but several household names maybe did not live up to expectations. A name like Target comes to mind. What is the broader sentiment about retail as we now continue into the heart of the holiday shopping season, knowing that a lot of that shopping, I mean, listen, the consumer is out there spending. Even if the consumer is spending savings, and there's indications that they are with the savings rates being where they are, people are spending. I mean, I don't know if it's this post-COVID, like they just want to get out there and live and travel and buy nice things for themselves and their loved ones. But how would you describe the state of retail based on the numbers we've seen the last couple of weeks and knowing what we'll likely see for the next few weeks?
Well, I think you put it well, actually, JD. I just think that there is a desire to get out there and spend and so to live in a way that reflects how we used to experience these holidays prior to the pandemic. And I think that's being reflected in a lot of the projections for Black Friday and the shopping weekend, which is going to see department stores and brick and mortar stores outpace growth for online. Now, that's a really interesting dynamic and does suggest these changing patterns that we're seeing both in apparel shopping and in other parts of the retail economy. But more broadly to your question about retail, it seems to me, it reminds me, if you will, of the old adage about it not being a stock market, but a market of stocks. In other words, there are differing conditions for each of the names that we see in the sector, and they're not all moving and experiencing the retail upsurge in the same way. You mentioned Target, absolutely underperforming, a dismal quarter and a muted outlook. Walmart was a little bit better in execution on third quarter and slightly more optimistic going into the December quarter. Some of the other retailers that we've seen were far more sort of optimistic about where they saw spending, some of it expecting to happen very early on in the holiday season, Best Buy being one of those examples. And last night, Nordstrom said it probably won't see a surge in spending for its customer base until later in the holiday season. That tells me, JD, that everybody is really sort of guessing right now as to where the patterns are going to emerge over this holiday season, not only this weekend, but into the end of the sales in the early part of January, because we're in such different territory right now. The job market remains robust, yes, but economic conditions, at least optically, are deteriorating. That is going to have some effect on consumer spending. We're seeing, of course, still elevated inflation, which is probably going to lead to consumers trading down to more value priced items and certainly into the food space in a way that they haven't in the past. And again, post-pandemic activity is probably going to bring shoppers out of their house and into the stores, and therefore off the online click. So put that all together, and it makes for a very difficult read, I think, going into tomorrow and indeed beyond. But your broader point, I think, is good. Spending is going to increase from last year. The consumer is relatively healthy compared to consensus. Certainly, there is some expectation that savings have been run down, but they're still at levels that will allow them to splurge and celebrate these holidays in the coming weeks.
Yeah, and maybe splurge is the right word, and maybe splurge is not necessarily what a lot of people watching these numbers from the outside want, but it also does bring me pretty seamlessly here to the next point, which is weekly jobless claims. It was one of the data points we were following, and it's higher than expectation, right? The expected claims were 225,000. This is for the week that ended on November 19th. That number is actually closer to 240. It is 240, excuse me.
240.
And we also had a slight upward revision from the previous week's numbers. You know, given the stated goals of the Fed, is that actually a good thing? I know that sounds scary and that may sound strange to people to say maybe an intentional uptick in unemployment is in part what we need to kind of cool things down a little bit. But what do you make of this data? And can it be interpreted as at least heading in the right direction?
It's probably too early to say, JD. These numbers can be quite volatile on a week-to-week basis. The 4-week moving average is something that's probably better to look at when we see the changes in applications for unemployment benefits. And that has remained relatively steady, although moving in an upward trend. The most important number, of course, will come next week when we get November job numbers from the Commerce Department and the broader employment report. But yes, you're right in the sense that it is a dismal science, is economics, in the sense that you do need to have a cooling in the job market in order to ensure that inflation remains at least on the trajectory that it is, and that's hopefully downward. That, of course, has a human cost in the short term, but hopefully a human benefit in the longer term, because, of course, the implications of inflation that remains unchecked are significant and indeed even more dismal than the fact that we sometimes look at jobless claims increases as good news. It's never a delightful thing to report, but in the broader macro condition, sometimes the truth is it actually is.
Yeah, of course. For people that don't follow the space very closely, the truth may oftentimes be a bit of a head scratcher in terms of the complicated mechanics that entities like the Fed have at their disposal. You move one thing one way, you got to adjust somewhere else, you got to adjust that and move it over, and it may seem counterintuitive, but that helps underscore just how complicated some of the things are that we discuss, and all the more impressive for the professionalism and ease with which you discuss these things on our show every morning, Martin. Earlier this month, of course, the Fed raised another 75 basis points. That brings rates now to their highest level. So I believe since March, we're now up 375 basis points total, 3.75. I think that's correct. What does a potential step down in policy look like? And I think it's been a few days since I asked you for the latest CME Group numbers. Expectation, we're still looking at 50, even despite some Fed commentary the last 72 hours?
Yeah, for the most part, JD, I think it's in and around that 75% threshold. In other words, there's a 75% chance that the Fed will increase its base interest rate by 50 basis points when it meets in the middle of next month. Now, that is down from about 85% just a couple of weeks ago, but it's still not to the point where we can call it a lock. I think that Fed officials have been trying to maintain the messaging that 75 basis points as an option remains on the table. I'm not sure that the market has entirely bought it, but nonetheless, we do see benchmark two-year Treasury note yields consistently rising. They tend to reflect where investors see the terminal Fed funds rate, and therefore that probably suggests that 75 basis points remains on the table, at least for the moment. But I think ultimately we are going to see a step down from those jumbo rate hikes, but nonetheless probably get to that 5% level for Fed funds in the early part of May. Because even with all of the discussion of recession, JD, it's remarkable to me that not only are jobless claims historically quite low, even though they rose last week, durable goods orders were incredibly robust for the month of November. They beat on nearly all metrics, even when you strip away some of the more volatile components. And the Atlanta Fed's GDP Now forecasting tool, which essentially tries to give you a real-time indicator of economic growth, says that fourth quarter GDP is rolling along at a 4% plus clip. That's nothing recessionary, and it will probably accelerate as a result of these durable goods orders themselves. So the recession talk is real, but it is not necessarily consensus in some of the data that we're pulling out. And that, of course, complicates the Fed's position. It makes today's minutes even more of an interesting read. And of course, it makes the press conference that Chairman Powell will deliver in December even more fascinating.
Absolutely. I didn't want to cut you off here, Martin. If you heard the noise behind me, I don't know if you could tell. We've got, there we go, Santa Claus
There he
himself.
is.
And again, for people who have not watched the Macy's Thanksgiving Day Parade, the parade famously ends with the arrival, formally, of Santa Claus, getting ready for a Santa rally. Martin, there's also a lot of conversation here. I think we'll keep the shot up here for a moment here about a so-called Santa Claus rally, which oftentimes we get around here. How you doing? How's the supply chain, Santa? We're looking good?
Excellent. Looking good. A little problems over New Zealand, but we're getting it all squared away.
We're getting it squared. There you go. That's a good scoop live on air. Santa, thank you, everyone. Happy Thanksgiving.
There we go. Right there. Yeah.
That's breaking news. Martin, I would like to formally give you the opportunity to respond there to that original scoop that we got here live on the show. He said the supply chain is looking good. Maybe a few headwinds, says the CEO of the Christmas season, over New Zealand specifically. Are you surprised there to have that commentary from Mr. Kringle himself?
I have worked remarkably hard this year, JD, to remain on the nice side of Santa's ledger. And I do not want my name to be moved over to the right or to the naughty list. So far be it from me to challenge the assessment of the CEO himself.
Absolutely. Well, that was a great visit here on the floor. You can hear the bells, and I do encourage people to tune in tomorrow. I don't know, maybe not. I love the parade. You know, this is true. My mom's job out of college for several years was to help design the floats. So our family has like a cool history with the parade. We win for many years, and we'll certainly be tuned in tomorrow to see that man and everyone else. It's a tremendous tradition here in New York City that the world gets to enjoy. Okay, back to the the issues at hand. Believe it or not, that's not the only thing to talk about. Though we could probably end the show right there, and it's about as good a way as any to head into the holiday tomorrow. I do want to ask you specifically about investor psychology right now, because there's a lot of stories that could kind of complicate things, make things a little bit muddled. Would you describe overall investor psychology as optimistic? Is it just kind of inundated and confused right now? How would you say maybe the average investor, if there is such a thing in this environment, is trying to take in all these swirling data points and understandable headwinds, including, of course, over maybe parts of New Zealand?
Yeah, I ultimately, JD, I think that one of the best ways that we can look at least at institutional sentiment is to look at the cash balances that are being held by portfolio managers around the world. The higher those cash balances are, the more reluctant it is for professional managers to put their money into risk markets, because they want to protect not only the gains that they fought for most of the year, but they want to be cautious heading into the new year as a result of the headwinds that you described. So for me, I am seeing those cash balances rise to about 6 to 6.2% of total assets. That's the highest it's been in about 2 decades. So at least at the institutional level, we are seeing extreme caution. even if we are seeing for the last couple of weeks a relatively solid gain for the S&P 500. I think the benchmark is up about 3.4% so far this month, and of course it crossed that 4,100 point threshold to a 2.5-month high last night. So yes, I think swirling is a great description for some of the metrics that we are trying to pinpoint at the moment, because underlying economic conditions do seem to be relatively robust. Inflation is moving in the right direction, but the Fed is staying on its rate hike path, and the bond market is telling us that recession is just around the corner. At this stage, JD, I just don't know who to believe. And I don't think institutional investors know who to believe either. And I think that's why, from a psychological point of view that you alluded to, we look at those cash balances, we see them being at elevated levels, and we have to conclude that they are more cautious than maybe some of the market activity suggests.
Is it fair to say that only now are investors, or will investors soon now, only really now, feeling the impacts of the Fed rate hikes, given when they started, given where we are now, and if they are really only feeling that now, does that underscore the reality that, as has been kind of made apparent by Fed commentary, rates are going to stay a bit higher than we previously thought, and they'll likely stay there in a more protracted way? They'll stay there for longer than maybe we had previously expected.
The market is starting to disbelieve that part of it, JD. In other words, they probably are believing, or at least buying, that the rates will get to a higher point. But if the economy were to turn lower, and indeed inflation were to get back to that 2% target, which Wall Street is really coming to terms with, it would be very difficult for the Fed to justify that high rate. There's no way we're going to stay at 5% if inflation is trending back to 2% in the fall of next year. So again, I think that sort of inconclusive aspect of it is part of the reason why we're sort of trending where we are from a stock perspective. But I think ultimately, so much is going to depend on how companies navigate these conditions more than the Fed does. Third quarter earnings were okay, but not great. When you strip away the energy sector, they were, for the most part, negative on a year-on-year basis. They're going to be negative on a year-on-year basis in the fourth quarter as well. How companies are able to control their costs, manage expectations, and grow their businesses next year may ultimately be more important than what the Fed is going to do, because, again, markets have, for the most part, accepted where the Fed is going to go and understand where it cannot go. And therefore, the one sort of remaining unknown is how companies are going to navigate the changing economic environment. And that's sort of what I think will dictate performance next year.
I do want to ask you about a few of those, one of those main specific companies. It's amazing to look at the names that really helped propel the market over the course of the last few years that have now taken an absolute beating here so far this year, year to date. And of course, the names that come to mind are Meta, down about 60%. You've got, what else do I have? Netflix, Tesla, Nvidia, Amazon down almost 50% or so. Tesla's a really interesting one, right? Shares down nearly 60% year to date. What are some of the major headwinds you think that have contributed to that company's rapid decline? Keeping in mind that its total value is still incredibly high, but we're not talking about the same slate of companies. This is not the same Tesla than it was a year ago. What are we to make of where Tesla sits as of November 23rd?
No, you're right. The headwinds now are so different, and they're mostly related to what's happening in China and supply chains and demand and things like that. Also, I think the fact that we've had significant selling of Tesla shares from CEO Elon Musk, in part to pay for his acquisition of Twitter and in part to satisfy a tax liability, that has been, has put extreme downward pressure on the share prices as well. And it has to be said, the distraction that Musk is now embroiled in trying to get Twitter profitable is only going to create further doubt about his ability to focus on Tesla's headwinds into the coming months and indeed into 2023. But what we saw this morning, actually last night and this morning, JD, was kind of a change of heart from two significant analysts, one who has been a longtime bear on the stock and one that has been a longtime bull. Citigroup analysts boosted their price target on Tesla to $176 a share. There was about a $35 increase. And they lifted the rating from sell to neutral. That's a big change for a bank that has been downbeat on Tesla's prospects. Morgan Stanley, however, which has been a long time bull for the stock and has a $330 price target, has said that the downward movement has probably ended, and that the $500 billion that the company has given back in terms of market value this year probably marks the bottom. So we are seeing a bounce in that stock right now. And I think in both cases, the assumption is that the Inflation Recovery Act and the ongoing demand for electric vehicles in the near term and Tesla's consolidated position in that market are going to drive value for the stock. So that's one example, JD, going back to our previous conversation about a company that will navigate changes in the global economy in the way that investors seem confident in. So that will be one example of a company that can do that because it is nimble and because it has leadership that understands those challenges and can make changes on the fly. It'll be interesting to see whether the other beaten down names are able to do the same.
Are there other potential EV names or opportunities that people might want to begin to pay a little bit more attention to if they had been relatively siloed into the behemoth that has been Tesla?
No one is really emerging as a clear number two to a great degree. I mean, NIO in China is a name I think that's worth watching simply because it is fighting for the same customer base that Tesla is in the biggest clean energy car market in the world. China, of course, has led many global economies in its effort to basically rid themselves of combustion engine vehicles. NIO, while much smaller than Tesla, nonetheless can provide a decent guide into China demand. So that's one name to look at. I think Ford and GM have ambitions in the EV space that they've committed a lot of capital to, but they do seem to be running well behind, and they're going to have to burn a lot of cash along the way in order to chip away at Tesla's multi-year leadership. But of the two names, I think Ford is one that has probably captured a bit more imagination in terms of its product offering, particularly with that F-150 Lightning. So I'll be very interested to see what Ford is able to do next year. Cash burn is going to be obviously an enormously important condition for that company. But nonetheless, if it's able to grow market share, that could be the early indication of a real Tesla challenge, at least here in the domestic market.
You know, since you mentioned NIO, I actually do want to end with this before we get to our rapid fire section. I know you watch a lot of the same general market commentary that I do, and there seems to be a bit of enthusiasm in China as an overall market to invest in. That's despite the very clear headwinds that how it hasn't impacted countries. But in terms of a lot of the things that seem to be working against the interests of the U.S. or other Western countries, they don't necessarily seem to have those same headwinds specifically in China markets with an eye to the future. I wonder if there's any thoughts you have there, because this is something that I've really seen tick up in conversation over the course of the last few weeks. Maybe it's just something that I happen to have noticed, but is there anything top of mind you think investors maybe should keep in mind, or something that maybe they're not thinking of as it pertains to all the chatter they're hearing about to say, maybe keep an eye on China in terms of potential gains?
An investor who isn't a pure professional in terms of his or her understanding of the market or their ability to glean data from China stocks should stay away. They really should. There's too much uncertainty right now from an audit perspective, from a perspective of management probity, and indeed, given the fact that Beijing and Washington are still at loggerheads about their trading relationship, about the industry, the tech industry, and the way that it bridges the two economies and the conditions therein. There are export restrictions, as we know, on high-tech products and activity from the United States into China, and for many good reasons. China has also been criticized for its lack of auditing authority on some of the companies that are based there and listed in the United States. There is some improvement on that front, and there is a slow grinding sort of acceptance that both countries need one another in terms of their not only economic conditions, but China's ability to raise capital and American investors' ability to get a foothold into that growing market. But it's simply too early, and there's simply too many unknowns, I think, for the average retail investor to put that much risk on the table. Again, I think beyond those who have professional distinctions and multi-decades of understanding of that market, I think it's one to stay away from, at least in the near term, and maybe, quite frankly, even possibly longer.
All right, time now for our rapid fire section with our remaining minutes in this morning's show. First up, let's talk Nordstrom. Yes, the company off to a bumpy start for the holiday season. Help me understand what happened here with the stock despite some positive info in the earnings. What happened?
Yeah, the earnings were actually not bad. They beat the street by about 7 or 8 cents per share on an adjusted basis, and they had 3.5 billion in revenues, which was a little bit better than forecast. But they are still suffering an inventory overhang, and as a result, trying to wind that down into the Christmas season is probably going to hurt profitability as a result. So they cut their full year profit forecasts, even if they say that their sales are going to be at similar levels than they expected. So I think the anticipation is that if they are able to wind down their inventory into the final months of the year, they can emerge into the coming year with a bit more capacity to buy the premium brand stuff that tends to do better for them because their clientele tends to be at the higher levels of the income scale and therefore have some better performance going forward. But what they told us in the conference call and what people glean from the earnings is that their Christmas season will likely be blighted by that inventory overhang. And as a result, the profitability that will come will just be delayed a few more months. So not necessarily terrible news from the consumer point of view, but from a company perspective, they're going to have more of a challenging holiday quarter than maybe first anticipated.
All right, number two, does Apple have to worry about even more COVID concerns in China?
Ooh, really worrying video images last night, JD, from that Foxconn factory in China, which is the biggest iPhone assembler in the world. There were workers were demonstrating against conditions, against accusations of bonus pay being held back. So we saw workers circling the plant. Some of them were smashing windows. So didn't necessarily turn violent, but it was absolutely aggressive in its nature and suggests that the closed loop system that's being operated in that plant is starting to buckle. And that, of course, could affect the output. And it, in particular, could extend the delay times that we're already seeing for the higher end iPhones, the iPhone 14 Pro and the 14 Plus. Going into the holiday period, that's exactly what Apple does not need. Demand, of course, remains solid, but if there is supply issues, then we could, of course, see sales pushed in to the January quarter and indeed beyond. Best Buy CEO Corey Barry actually said yesterday that she is seeing some supply pressure on those higher end iPhones, and as a result, customers are finding it more difficult to locate them in the stores. So I think this one will have to be watched closely. The demand picture, again, hasn't changed, but that may not matter if supply cannot meet it. So I think investors are starting to get a little bit more concerned about these protests and about these disruptions as we head into the holiday period.
All right, number three, Martin, what led to Deere and Company bulldozing? Nice. Its expected Q4 earnings.
I love a pun like that. They really did. They smashed the street. 744 was the bottom line, and actually they had about 15.5 billion in sales. Their net income, in fact, was up about 80% from last year's level. So that's a really significant gain for a company that's been able to use pricing power for the industrial equipment and to lever onto the increase in farming demand, which is happening not only here in the United States, but in markets all over the world. It may not necessarily be the best sort of indication of where we're headed in food price inflation. In other words, that's probably going to continue if farm demand remains as robust as what Deere is saying it is. But this stock itself might be a cheaper way to play that trade vis-a-vis Caterpillar and vis-a-vis some of the other mechanics that we've seen, because food price inflation does seem to be becoming more permanently embedded in the inflation picture than we thought even just a few months ago.
All right, and fourth and final. Wow, this was a wild one yesterday. Will the Glazers actually sell Manchester United? this whole thing with Ronaldo, the Piers Morgan interview. I mean, it has been strange, right?
It's always strange with Man United, and it's always emotive. And in fact, the Glazers have been an unpopular ownership family with respect to Man United since they bought into the club in 2005. They've always been accused of saddling the club with too much debt. And quite frankly, as American owners, they were never really welcomed by a club with such storied history. They've won the league 20 times. They've had 13 Premier League titles, all of them under Sir Alex Ferguson, who retired in 2013 himself. The club has been kind of on lean time since then. It hasn't won a significant trophy since Sir Alex left the club. And as a result, that's just increased the disquiet amongst the fan base. and it's made for grim reading for those who sort of see this as a barometer of health for the most popular sport in the world, and indeed the most popular sport in the United Kingdom. So the Glazers came out with a statement this morning, said they're going to explore all kinds of options. People read that as an intention to probably sell the club, and I would imagine that's where they are headed indeed. The price tag, JD, could be as much as $5 billion US dollars and perhaps beyond. That's about the same number that we're seeing for the Washington Commanders, if indeed a full sale of the NFL franchise were to be executed in the early part of next year. So we'll watch it with interest. But this stuff isn't cheap. And actually, we're seeing the billionaires starting to exit, if you will, the British football market. We've had, of course, Roman Abramovich with the for sale of Chelsea, and there's talk of the ownership group for Liverpool FC also thinking about leaving. Not great news for an economy that needs a little bit of good news along the way, but potentially maybe some good news for a Manchester United fan base that never embraced the Glazers and probably never will.
Yeah, of course, Manchester United PLC does trade right here on the floor of the NYSE so far this morning. It is up, excuse me, more than 13%. Real quick, any take here on this Ronaldo thing? I feel like this has been very strange. Again, that interview, is it all but certain here he leaves, and if so, where does he go? Where does he go?
That's a great question. He's a mercurial player, and he's into the twilight years of an incredible career. There's no question about it. So I do admire him to one degree for deciding to speak his mind, if maybe not necessarily supporting the venue in which he did it. But I can't imagine there's going to be a lack of buyers for a player who's still incredibly fit. He's going to be one of the leading players on the pitch for Portugal in this World Cup. Whether he'll want to return to his home market remains to be seen. But if he were to find a space in France or indeed Italy into the coming year, I wouldn't be surprised. He still has a lot to offer, an incredible talent, and somebody who's been true to himself, I think, as a player throughout his career. And that's something I've always admired.
Something I thought was funny when I was in Lisbon and I went to a Sporting Club of Portugal match. That's, of course, where Ronaldo started his career. He only played two dozen or so matches there when he was a very young guy. His mother has famously said she would like to see him return to Sporting. She lives there in the neighborhood in Lisbon. What's funny, when you go to a Sporting match, they still have Ronaldo's name up featured very prominently as one of their favorite sons, which to me is the equivalent of like the Atlanta Falcons having Brett Favre's name up, because technically he did play there to start his career, even if that's not where he became a legend. So I know there's more than a few people in that part of Lisbon would love to see him return. I don't know how likely that is, but I guess we'll see.
Yeah. His history is much like Wayne Gretzky in the sense that he was a prodigy from a very early age, and is someone who has basically just captured the sport's imagination all the way through. He hasn't had, obviously, the same record-breaking success as the great one, but nonetheless, he's been an incredible player and really one of the best in Europe, I would say, for the past 50 years.
Yeah, we'll see how Portugal does in the Cup. All right, Martin Baccardax, thanks a lot. A very happy Thanksgiving to you, and enjoy your next few days of football as well.
Thank you, JD.
Of course, both types of football is what I mean by that. That's going to do it for the Market Open here from the floor of the New York Stock Exchange. And before we go, a very quick programming note. There will be no show tomorrow or on Friday in observance of the truly great Thanksgiving holiday. That's going to do it for the show here. Enjoy your holiday. Be safe if you're traveling with your family. And we will see you again next week. Have a great day.